A question I get a lot is how current and expected future inflation and interest rates should influence our investing. Should we invest differently because we think perhaps inflation and interest rates are going to go up in the near term, or perhaps we think they're going to go down? How should that affect our portfolio, particularly for folks in or near retirement? Well, today, Jerome Powell, the chairman of the Federal Reserve, really gave us an opportunity, sort of a masterclass opportunity, to learn a lot about investing, interest rates, and inflation. And I want to walk through what he taught us today. I don't think that was his point, but he taught us a really important lesson. And so I want to share that with you. So let's dive right in. We'll start with what he said. Here you go. This is just from a CNN article published earlier today, or April 16th, 2024. I've highlighted here one of his remarks. He said, "Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us." So what in the world does that mean? Well, restrictive policy just means they've raised the Fed funds rate. They've raised short-term interest rates to try to slow down the U.S. economy and bring inflation under control, which for the Fed would mean 2% or maybe 2-ish%. Of course, it's about 3.5%, so it's not as low as they would like. And so they've kept that interest rate higher. Of course, that affects borrowing rates and a lot of other things. And so he means restrictive policy, kind of keeping things where they are. And then when he says, look, we're going to sort of let the data and the outlook guide us, honestly, that's a fancy way of saying, we don't know yet what we're going to do. We're just going to wait and see. That's what we're doing. We're going to look at inflation data as it comes in and economic growth. They're going to keep a close eye on unemployment, and we'll make decisions down the road. And she say, okay, well, that's fine, Rob, but how does that teach us something? Well, we got to go back in time just a little bit. I want to show you something, tell you a little story, if you will. And we're going to start in December of last year, December of 23. This just happens to be one article I could have shown you. This is from Morningstar, why bonds are making a huge comeback. Here they point out that yields on the 10-year Treasury had were roughly at peaking at 5%, but they had come down. Inflation was coming down. 10 years had fallen to 4.26%. And if we come down here they were saying, look, bond traders. Now, these are people that do nothing but try to figure out future inflation rates and interest rates. That's what they do for a living. And what they said was, hey, bond traders now expect the Fed to cut rates at its March meeting. Now, we're in April, and they didn't cut rates in their March meeting. So, oops, they missed that one. And that was just 3 months earlier they got it wrong. But that's what they were predicting, right? And that was just in December, right? And they go on, they said, in total, bond futures markets are pricing in 1.25 percentage points of easing cuts by the end of 2024, or 5 separate rate cuts of 0.25% each, 5 separate rate cuts. Again, that was just in December of last year. So what, about 4 or 5 months ago, right? Now, we can fast forward a little bit. Now we'll go up a month. Now we're in January. Here's CNBC. The Fed is expected to cut interest rates in 2024. Here's how investors can prepare. So here now they're saying, look, as an investor, you should be doing some things in preparation for this rate cut. Now I'm going to tell you now, I don't believe in that approach. And I think the story that we're looking at now as we move through the last 4 months underscores why. But this was CNBC. Fed is expected to cut interest rates. Here's how you can prepare. We go forward. Now we're March 20th. And March 20th, CNN reported that stocks surge after Fed indicates 3 rate cuts. So remember, if we go back to December, the bond traders were saying 5 separate cuts. Now we're just a couple of months, now we're in March, right? So 3 months later, it's 3 rate cuts. Okay, well, I guess 3 is better than nothing. So now we're at 3 rate cuts. And you can see here, actually, we'll go back. This was March 20th. What triggered this was what's called the dot plot. This is a report that the Fed issues, I think it's 4 times a year. And the members of the Fed sort of predict where they think interest rates are going. And so this section here is for 2024, and you can see the dots represent a prediction. And most of the predictions came between 4.5 and 5. Right now, the Fed fund rate is 5. I think it's 5.33. So, we're only in April, so that could still end up proving to be true. I suspect there's at least a good chance when they issue their next report, we'll see these numbers ticking higher. But again, that's just a guess. That was March 20th. Now we fast forward just a couple of weeks. Now we're April 3rd. Powell hints Fed still on course to cut rates 3 times, despite, it's in 2024, despite inflation uptick. That was this month. That was less than 2 weeks ago. And then the Wall Street Journal, this is 5 days later. Doubts creep in about a Fed rate cut this year. Traders started the year predicting they said 7 rate cuts. My goodness. Now many are betting on 1 or 2 or none. And then after the Fed chair's comments today, I don't subscribe to the Washington Post, but you can see the headline: the sobering message from the Fed. Interest rates cuts aren't coming soon, right? And then what we've got here, stock market today, Wall Street wavers as worries rise about interest rates staying high. And if we come down here, traders are mostly betting on the Fed delivering now just 1 or 2 cuts this year, after coming into 2024 expecting, according to this article, 6 cuts. They're now also betting on a 14% probability that 0 cuts will arrive, up from just 1% a month ago. So in the course of about 4 months, we went from, it was 5 rate cuts, or some said 6 rate cuts, or some said 7 rate cuts, to, maybe it's not so good, maybe just 3, to, okay, the Fed, he's reassured us, we're going to get 3 rate cuts, so that's something. And then, today, you know what? We're not really sure. Maybe not get 3. Maybe you might not get any, some are now predicting, but we don't know. We're just going to let the data play out, and we'll decide. We're going to take a wait-and-see approach to this because, frankly, we need to see inflation come down. Unemployment is still running extremely low, which can encourage inflation. And so, we're not cutting anytime soon, and we're just going to let the outlook and the data guide us as it comes in over the coming months. I think this is a really important lesson for us to take hold of and to learn from. Predicting future inflation rates, even if you're the Fed. Okay, so these are all PhDs that do nothing but study inflation their entire career. They can't predict it. You've got bond traders, their entire livelihood, getting paid, depends on predicting inflation and interest rates. They're not good at it. And I'll be the last person to suggest I can do it. And so I think the best approach, at least for the vast majority of investors, maybe all of them, but certainly the majority of them, is to come up with a portfolio that doesn't depend on a certain inflation and interest rate outlook. It's one of the reasons I include both regular bonds in my portfolio as well as TIPS, because TIPS are inflation protected. So I get sort of a benefit from both. And in that kind of portfolio, I'm not worried about what inflation is going to do or what interest rates are going to do, because I know over a long period of time, sometimes they're going to be higher than I'd like, sometimes they're going to be low. I've got a well-diversified portfolio that will do okay in any interest rate environment. That doesn't mean it's not going to have some losses in some years. It certainly will. 2022 was a tough year, I think, for all of us. Certainly it was for me. But I also know that when bad years happen, often good years follow, and that was, in fact, what happened in 2023. So that's what's going on today with the Fed and Chairman Powell. But I thought it would be useful to sort of look back, and we just went back a short period of time, just 4 months. I mean, goodness, we can't predict 4 months. The best experts in the world paid to do this are terrible at predicting a future inflation and interest rates, even in a relatively short period of time. We shouldn't fool ourselves into thinking we can do any better. There you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.